Picture a country that, for 15 years, demanded every other Eurozone member submit to fiscal austerity. Greece, Italy, Spain, Portugal. Each one got the same message: restraint or no rescue. That country wrote spending discipline into its own constitution. It became the rule setter, the anchor. Then the rule setter amended its own rule. 63%. That's where its debt to GDP stood before the vote. The projection now climbs past 100% over the package's drawdown. 1 trillion euros of new fiscal capacity. The anchor pulled up its own chain. This is Germany. Most people still think the country is the discipline backbone of the Eurozone. The data tells a different story. The country that demanded austerity from every other member just exempted itself from comparable rules. 3 stages will play out over the next 24 to 36 months. The mechanism is simple, the implications aren't. Call this the Anchor Abandonment Mechanism. 3 stages. Stage 1. The rule setter changes the rule. Stage 2. Bond markets reprice every member's risk premium against the new anchor. Stage 3. Contagion flows through 19 sovereign markets at the same time. Each stage triggers the next. Miss one and the move looks random. See all 3 and the logic is obvious. Start with the constitution itself. The German debt brake was a constitutional rule. It capped structural deficits at 0.35% of GDP. It was installed in 2009. It became fully operational by 2016. Amending it required a 2/3 supermajority of the Bundestag. That high bar wasn't accidental. It was the entire point. The rule was meant to be permanent. For comparison, the United States changes spending rules with a simple congressional vote. Germany made its rule constitutional on purpose. The threshold was meant to be so high that only a genuine national consensus could move it. That's exactly what happened. A 2/3 vote moved it. Think of it like a dam wall built deliberately too thick. The point of the design is that you can't change your mind about it on a regular Tuesday. You'd have to take a hammer to the wall itself. That's what the Bundestag just did. So what changed? 2 specific things. First, the amendment exempted defence and security spending above 1% of GDP from the deficit ceiling. Second, it created a €500 billion extra budgetary fund for infrastructure, and expanded state-level borrowing room up to 0.35% of GDP per state. Total new fiscal capacity above the structural baseline reaches roughly €1 trillion. Think of it like a household. It wrote a no-debt rule into its mortgage contract. Then it voted to rewrite the contract. The new spending isn't the story. The fact that the rule was rewritten at all is. That's stage 1. Stage 2 is where the bond market does its job. Coming up, watch what happens to a sovereign's borrowing cost when its fiscal anchor amends itself. The German 10-year Bund yield is the benchmark cost the German government pays to borrow for a decade. It has climbed to roughly 3.1%. That's the highest level since 2011. The 30-year Bund peaked above 3.3%, also a 15-year high. The move began the moment markets digested that the constitutional ceiling had moved. Translation: investors are now demanding materially more interest to lend Germany money over a decade. The repricing equals roughly 130 to 150 basis points above where the Bund traded before the vote. For a sovereign that issues hundreds of billions in new debt every year, that's a real cost. And it compounds every year going forward. Here's what that looks like in practice. A regional bank in Tuscany holds German Bunds as collateral. That's the safest asset on its balance sheet. The bank borrows short-term against those Bunds. It lends long-term to local businesses. When the Bund yield rises sharply, the collateral loses market value. The bank has to post more collateral or shrink its loan book. Multiply that by hundreds of European banks holding Bunds as their safety asset. That's how one constitutional amendment travels through 19 banking systems. Most people think bond markets price default risk first. For Germany, that's true at the margin. The biggest story is the credibility premium. Italian, Spanish, and French bonds traded at narrower spreads to German Bunds. Why? Because the market assumed Germany's constitutional anchor was permanent. Spread is the gap between 2 interest rates. It was the price of that assumption. The amendment revised the assumption. The spreads have to follow. That's stage 2 of the mechanism. Stage 3 is contagion, and it's already moving, but the pattern isn't perfect. Two scenarios could break it. Could defense spending attract premium buyers? Possibly. Strategic deterrence value matters to NATO allies, to sovereign wealth funds, to pension funds in countries that want exposure to European security guarantees. They could hold German paper for strategic reasons, not just yield. And what if German industrial revival actually succeeds? Then the GDP denominator grows faster than the debt numerator. Both factors could absorb the package without triggering full contagion. Don't dismiss this. The bull case is real. For 15 years, German fiscal conservatism exported deflationary pressure to the entire Eurozone. Demand stayed weak across Italy, Spain, and France. The Bundesbank's price stability hawk stance was enforced through European central bank policy. It kept rates too high for the periphery. It kept demand too weak for German trading partners. A Germany that finally borrows and spends is a Germany that generates demand. Demand for Italian steel, for Spanish engineers, for French industrial services, for Polish construction equipment. Could the package produce real GDP growth of 0.5% to 1% annually above baseline? Possibly. If it does, the Eurozone-wide multiplier could reduce peripheral debt ratios faster than 15 years of austerity ever achieved. That's a real and credible counter case. So we have two parallel tracks: the contagion case and the multiplier case. The mechanism doesn't pick a winner, it says. The next 24 to 36 months reveal which force dominates. Remember the three-stage sequence. This is where stage 3 actually fires. If one specific spread crosses 250 basis points, the contagion case is in play. If it stays below 150, the multiplier case is winning. That single number is the tripwire. By the time it crosses, the rest of the sequence is already underway. Here's how contagion actually travels. The BTP-Bund spread is the gap between what Italy pays to borrow for 10 years and what Germany pays. It was around 115 basis points before the amendment. That's a more than 3-year low. Italy carries debt at 137% of GDP. It traded close to Germany at 63. Why? Because the market treated Germany's anchor as permanent. Once Germany trends toward 100% over its package drawdown, the math changes. Italy at 137 and Germany at 100 look like the same risk neighbourhood. Test yourself on this. Italy didn't deteriorate. Its deficit actually narrowed. It dropped from -8.1% of GDP in 2022. It reached -3.1% in 2025. Germany got worse. So why would Italian yields rise? The answer is mechanical. Bond markets price relative risk. When the safest borrower's risk goes up, every other borrower in the same currency is repriced against the new baseline. Italy didn't change. The yardstick did. That's the contagion mechanism. And it doesn't stop at Italy. A French government auctioning new debt faces a math problem most people miss. The OAT-Bund spread is France's borrowing premium over Germany. It's structurally pressured by France's own fiscal weakness. France runs a deficit of -5.1% of GDP. Its debt-to-GDP sits at 115.6%. Add German yield repricing on top, and France's effective borrowing cost moves up from two directions at once. The French Treasury isn't punished for its own behaviour. It's punished for sharing a currency with a Germany that just blinked. That's the second leg of contagion. The first was Italy. The second is France. The third, if it arrives, is reserve currency rotation. So, how big is the system at risk here? The euro holds roughly 20% of global foreign exchange reserves. That's down from a peak near 28% in 2009. The number has drifted lower for a decade. Reserve managers may respond to the new German trajectory. If they accelerate that drift, the euro share could fall below 18% within 36 months. That's not collapse, it's structural drift. But it changes the price of every euro-denominated bond. Here's the bigger framework, the takeaway you carry beyond this video. Every monetary union without fiscal union depends on the discipline of the anchor. The Bretton Woods system depended on United States restraint. The European exchange rate mechanism depended on German restraint. The post-2012 Eurozone recovery depended on Germany's constitutional anchor. That anchor provided implicit credibility to the European Central Bank's bond buying tool. When the anchor changes the rules, even for defensible reasons, the entire system reprices the probability distribution of future anchor behavior. In 1971, the United States suspended dollar-gold convertibility. It didn't intend to end the Bretton Woods system. It intended to buy time after a decade of Vietnam-era pressure on the dollar. The result was structural. The fixed exchange rate regime collapsed within 2 years. Germany didn't intend to signal Eurozone fiscal indiscipline. It intended to respond to defense pressure and an industrial contraction at home. Vehicle production fell from 5.65 million units in 2017. It dropped to under 4 million by 2024. The auto sector shed 51,500 jobs in a single year. That's nearly 7% of the workforce. Exports to the United States dropped about 10%. Exports to China dropped 14%. The intent was domestic. The consequence is system-wide. Mechanism credibility doesn't care about rationale. One thing the data can't tell you: the historical parallel doesn't guarantee the same outcome. 1971 had no alternative anchor for global trade settlement, so the dollar kept reserve status even after the rule was abandoned. The Eurozone has the same structural feature today. There's no obvious replacement currency for European trade. Does that make the repricing painless? No. It just means the rotation, if it comes, takes years, not months. Quick question before we close. The world's most fiscally disciplined large economy just rewrote its constitutional spending rule. Would you still price its bonds as the safe haven anchor? Most market participants would say, probably not. That single answer is what Stage 2 and Stage 3 are measuring. Picture a Spanish pension fund. Its mandate says to hold a core allocation in German Bunds for capital preservation. For 15 years, that allocation behaved like a near-cash anchor. Yield was low, price volatility was low, capital was safe. The fund built its entire risk model around that assumption. Now the same allocation is sitting on a 15-year high yield. The price has dropped, the risk model is wrong. The fund has to decide, hold or rotate. Now multiply that single decision. Every pension fund, every insurance balance sheet, every reserve account that treated bunds as the safe leg of a barbell strategy. That's the real transmission channel. Spreads widen, risk models reprice, allocations rotate, each one a small move on its own. Together, they reshape every interest rate in the currency zone. This is why monetary union without fiscal union is fragile by design. The anchor isn't a country, it's an assumption about a country, and assumptions can be revised in a single afternoon. 3 signals tell you which scenario is winning. First, the BTP-Bund spread. If it crosses 250 basis points on a sustained basis, the contagion case is the dominant force. Second, the OAT-Bund spread. If it crosses 90 basis points at any weekly close, France joins the repricing. Third, reserve manager disclosures from major central banks, the People's Bank of China, the Saudi Monetary Authority, the Reserve Bank of India. If any of them publicly reduces euro-denominated holdings, the rotation has started. They fire in sequence. The BTP-Bund spread moves first. The OAT-Bund spread confirms. Reserve disclosures arrive last. By the time the third signal lands, the trajectory is locked in. For 15 years, the Eurozone borrowed credibility from one country's constitutional discipline. That credibility was the cheap collateral underwriting 19 sovereign bond markets. The amendment didn't end the system. It reset the price of the collateral. The next 24 to 36 months tell you which way the reset moves. Watch the 3 signals in order. The mechanism is simple. The implications aren't.